All right, chapter 9, when we are talking about receivables. So we're going to go into a little more in-depth about some of the accounts we've already talked about. The main receivable we have talked about so far is accounts receivable. When we make a sale on account, we debit accounts receivable. This is a current asset, right? And so on our balance sheet it shows up with the current assets because this is money that we are expected receiving very soon. It's very short term, usually 30 to 60 days we expect to receive this money, if not less. This is what we call trade credit. So when we when this is kind of what we were talking about in chapter 5 when we said the credit terms were 210 net 30, and so discount, but you have to pay within 30 days. So that's what this is, this trade credit. This is not customers coming in and buying stuff with a credit card, and we'll talk in a second about why that's different. But for this one, it's very informal. I just say, okay, here's the sale. I'll send you the material. And I'll send you a bill, and you pay me in 30 days. So that's that, and that's mostly what we've dealt with so far in receivables. We've also seen a little bit, but we're going to talk a lot more in this chapter about notes receivable. And so this is a much more formal agreement. And it can be I'm lending somebody money, or it could be sometimes an accounts receivable turns into a notes receivable. But this will be a longer term. So this is usually 90 days or more, 90 days, 120 days, maybe even up to a year. But this is going to have a written agreement now instead of just, this informal agreement. It's going to have a written agreement that's going to express these terms. I'm now going to charge them interest, and we will specify a maturity date. That's the date that this note matures and they have to pay me. So we're going to talk about that in this chapter. There are a couple of other receivables which we see less often. There is interest receivable, which we will talk about a little bit. And then there's some other things like dividends, receivable. So anything that I'm expecting to collect at some point is receivable. So receivables are always assets. Even notes receivables are generally current assets because I should be receiving most of these within a year. So let me talk about credit and debit card sales. And so these are not accounts receivable. And the reason, so these are treated as cash sales. And the reason is I don't have to wait until the customer pays. I get paid right away. So I have a bank that represents me. And so as soon as the transaction takes place, my bank puts the money in my account. So this would be an electronic funds transfer like we saw in chapter 8. But I get paid right away. And so then my bank puts the money in my account, and then my bank gets paid by Visa MasterCard as it goes through interchange. And then Visa and MasterCard passes that on to the bank that represents the customer or the cardholder. And so then that bank has to collect it from their cardholder. So if that cardholder never pays, or if they take a long time to pay, it doesn't matter to me, the merchant, because I got paid right away. And that's why this is not an accounts receivable. In accounts receivable, I don't get the credit, I don't get that cash until the customer pays. But now I get it right away. So that's why these are treated as cash sales. The bank that represents me, the merchant, is called a processor, and they charge a fee. So they charge a fee to the store or the merchant or the business or whatever this is, for doing all this processing and for whatever all the so how much they charge is an agreement between the two of them. Just the same way, if you have different credit cards, they all have different terms, and they have different payment terms, they have different interest rates, they have different fees that they charge, and so they're all a little bit different. And so this is the same way. And so the processing bank and the merchant or the store or the business will have some sort of agreement on how they're charged. It could be a flat fee, it could be more likely a % of the credit sales, or some combination of the two. Sometimes they're charged both. And they probably have to rent or buy the equipment or that might be included in the fee, the equipment that does the processing, that that they swipe the card through and all that kind of stuff. So there's all kinds of different ways that can do. But as far as the money getting deposited into the business's account by the processor, there's two ways. There's the net method is the first way, and the cash that gets deposited into the business's account is equal to the total sales, or the total amount of the sale, or the sales for that day or whatever, less the fee that the merchant charges. And so they never see the entire sale, they just see the sale minus the fee that they got charged. Under the gross method, the cash deposited equals the total sale. They just deposit the whole thing, and then at the end of the month they go back and charge the fee, and they just take that out of the account, and so it's a credit to cash. They take it out of the account as a credit to cash. And that's kind of what, remember when we did the bank reconciliations, we see that less the fee or whatever, so we would see that kind of thing in here. So there are let's just do I think I just have one transaction here where we're looking at credit and debit card sales. So for this one, this restaurant does business through both credit and debit card sales. And suppose that they have these transactions for January. In the first one, we're going to say, let's say they charge a 2% fee and then you use the net sales method. So the way the transaction would look, if this was just a cash sale, I'd be debiting cash and I'd be crediting sales revenue, right? So I'm going to credit sales revenue for the total amount. We'll do these in two transactions. $10,800. But this is net, so they're going to take off the fee. So I'm going to debit credit card expense for 2% of the credit sales. So that comes out to $216. And then the difference is the cash that gets deposited in my account, which is $10,584. So the sales are recorded for $10,800. The cash that gets deposited, though, is only $10,584, and the difference is that fee. And we do the same thing for the debit card sales. I'm going to debit cash, I'm going to debit credit card expense, and I'm going to credit sales revenue. So credit sales revenue for the total sales, that's $10,000. Credit card expense is debited for 2%, which is the $200, and then the difference, $9,800, is what gets deposited in my account for cash. Number 2 says, let's say they use the gross method, and so then it just looks like a cash sale. So I debit cash and I credit sales revenue for $10,800, and then I debit cash and I credit, it's really hard to write at the bottom, sales revenue for $10,000. And so it just looks exactly like a cash sale. Now the difference would be then at the end of the month, and they don't ask you to do this in here, but if you're using method 2, the end of the month you'd go back, or you would be notified maybe on your statement or something what the fee was, or you'll get a statement. So you debit credit card expense. Let's say this is all one, and so it would be the $216 and the $200. So debit, trying to put this in here, I'll just call it card expense, $416, and credit cash, $416, because they take that out of your account. So at the end of the day, here your cash is the $10,084 plus the $9,800. Here it would be $20,800, but then I'd credit cash $416, and so the bottom line would be the same. Either way, I'm getting charged a total of $416 in fees, and the total cash that I'm getting is $20,384 or whatever. Either way I do it, at the end of the month I end up the same. Okay, so that's credit card and debit card. The next thing we want to talk about in this chapter is writing off uncollectible accounts. And so uncollectible accounts are accounts receivable who did not pay. So I did not collect the accounts receivable. So we have a new account here called Bad Debt Expense. There are two methods for recording this. The first one is called the direct write-off method. And I can use this if I am a small business, not publicly traded, just a little guy. The second method is called the allowance method. And this is the one that is required by GAAP. So if I'm big enough to fall under GAAP, I have to use the allowance method. And the reason why is, I'm going to have a new asset here. A new account. It's called a contra asset, called allowance for bad debt. Now we've seen a contra asset before when we talked about accumulated depreciation. And so in that one we would say the asset minus the accumulated depreciation gave us the book value of that, what it was really worth, so to speak. So we've got the same type of thing here. We'll have accounts receivable, which is the asset, minus the allowance for bad debt, which is the contra asset, gives us what we call the net realizable value of the accounts receivable. So accounts receivable shows me what people owe me. Allowance for bad debt shows me what I estimate I'm going to not collect. And so the net realizable value shows me what I really think I'm going to collect, which is a much more accurate number to show on your balance sheet. The accounts receivable says, oh, I have this much money coming, but we know we're not going to get all that. So the net realizable value shows me what I actually expect to collect. So the new accounts we have are the bad debt expense, the allowance for bad debt, and then the other new thing we're introducing here is the net realizable value, which again is very similar to like the book value for assets. So it's what it's actually worth, kind of. So let's do the direct write-off method. Again, this is only used by small, non-public businesses. Non-public mean they're not publicly traded, they're not out there trading their stock on the stock exchange. Which really means probably nobody except a bank maybe is going to be looking at their balance sheets. I write off bad debts when there is no hope of collecting. And that's a little bit vague, which is why we can't use this for allowance method, because in theory, it could have been a 30-day accounts receivable, and it's 5 years later, and you're still saying, no, I still think he's going to pay, and so you leave that on your books as an asset, when it really shouldn't be. You shouldn't be reporting that as money you're still expecting to receive. At this point, I stopped trying to collect it. So I'm actually going to wipe it out of his accounts receivable. So the journal entry is bad debt expense, and then I credit accounts receivable and the person's name to show which account I'm clearing up. And so then there will no longer be showing anything in accounts receivable for S. McGee, because I'm no longer expecting to collect anything from S. McGee, and I just write that off as an expense. So we have two problems here related to this. And this one, Susan Knoll is an attorney in Los Angeles. She uses the direct write-off method. She starts out the month with $18,000 in accounts receivable. During the month, she makes sales on account of $21,000. She collects $23,000 from previous accounts, and she wrote off a bad debt of $1,050. So the first thing we're going to do is write off this $1,050. So I just debit bad debt expense for $1,050 and credit accounts receivable $1,050. And that's all I do for that one. The second part says, what's the balance in accounts receivable? So of course we want to do a T account for that. We started off with a balance, and it's an asset, so it has a debit balance of $18,000. We made sales on account. So we make a sale on account, we debit accounts receivable, and we credit service revenue. So I'm going to debit over here $21,000 for the revenue I earned this month. We collected $23,000. So when I collect, I debit cash and I credit accounts receivable. So I'm putting that over here on the credit side. And here on the write-off, I can see I credited accounts receivable. So I'll put that on the credit side. Oops, that's not balance, that's collected. And this is my write-off. So then debit plus debit minus credit gives me my new balance of $14,950. So that's the ending balance in accounts receivable. All right, one more. So Gate City Cycles has had trouble collecting accounts receivable from Shauna Brown, and on July 19th they finally wrote that off. So I'm going to do that one first. On July 19th, I wrote off the $700. So I'm going to debit bad debt expense $700, and I'm going to credit accounts receivable Shauna Brown for $700. And so that's it. I'm no longer expecting to receive that from her, and I'm done. But then, lo and behold, there's a Christmas miracle. She gets some money. She decides to make good on this debt that she owed us, and so on December 31st, we receive a check from her for $700. So the first thing we do is reinstate the accounts receivable, and reinstating it. So this is the write-off here, and now I'm going to reinstate it. And all the reinstate is undoing the write-off. So I'm going to debit accounts receivable as Brown, and I'm going to credit bad debt expense. I just do the opposite of whatever I did in the write-off. Bad debt expense for $700. And now that it's sitting back in accounts receivable, I just record the payment like I would any other payment. And so I debit cash and I credit accounts receivable Shauna Brown $700. And that's what I do. Alright, the next thing we're going to talk about is the allowance method. So I think I'm going to put that in a second video. We'll probably have 3 videos for this chapter. Because there are 3 different methods for the allowance. So let's put those all together in one. So I will be right back with part 2.